This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we have a great show for you today. We got an excellent guest. This is one of the smart guys, and he's going to give us a whole different look at real estate investing that we really haven't explored a lot on this show. The person I'm talking about is Brian Daly, and he's the co-founder and CEO of Ground Floor, a real estate investing and lending platform that opens private capital markets to everybody. Under his leadership, Ground Floor became the first and only company qualified by the SEC to offer real estate debt investments via Regulation A that are available to non-accredited investors. Brian's 15-year career building disruptive technology startups, and I'm definitely going to have to ask him what that means, spans stints in Silicon Valley, Boston, London, and North Carolina Triangle region. Previously, he led the launch of Republic Wireless to take on the 4 big cell phone carriers to international acclaim. As a result, millions more Americans can now afford a smartphone. Brian has a JD from Harvard Law School, an MBA from Harvard Business School, and a BA from the University of Virginia. Well, Brian, welcome to the Old Dogs REI Network.
Oh, thank you. I'm really happy to be with you today. Thanks, Bill.
Well, it's great to have you here. This is going to be a neat interview. I think it's going to be a lot of new stuff that our folks are going to be very interested in. First off, I thought, maybe we could get to know you a little better, and maybe you could just give us your story. Where do you come from, and how did you get into this crazy real estate world here?
Well, I grew up in Winston-Salem, North Carolina. And I was one of those people who, as a kid, thought, I wanted to live anywhere as an adult that wasn't where I grew up. But I made myself a liar. I managed to return to North Carolina and the Southeast and have been here for about 15 years. So that's where I grew up. But somewhere in the 90s, I got bitten by the internet bug. I was a kid that in high school and college had played around, writing software. And somewhere in the mid-90s, when I was starting law school, I took on my first website project just as a way to learn how to write software for the web, and I've never looked back. I've been doing one type of internet business, technology business, or another since then, going all the way back to the mid-90s.
Wow. Well, you're from a beautiful part of the U.S. Man, I I can't blame you for sticking around there. That's just absolutely God's country out there. I love it out there.
I managed to wander quite a ways, Boston for grad school, Chicago, Silicon Valley, London, and I built startups in all these places, and finally have ended up here in Atlanta, Georgia. So, building ground floor here in the Southeast.
Well, really neat. Now, you primarily came from the tech side of things. Obviously, it sounds like you probably were through the tech boom, and that hit us all. In fact, I was working for an internet company that was launching here on the West Coast when the tech bubble burst, and that wasn't fun. But it's definitely an exciting area, and I love technology. I love the developments that are going on. When I do invest in stocks, that tends to be the direction I go.
Is that your pick?
Yeah. I understand it better, I think, and
Yep.
but that's definitely a kick. And looking at your background, it seemed like you were set up to practice law, but it didn't sound like you really practiced that much. You really jumped right in the tech side of things and running and starting small tech firms, and that grew into big tech firms here.
Yeah, I just realized that there was just a lot of opportunity that was well suited to what I was interested in. And, people ask me all the time, have you used your legal education or do you use it in your work? And it's kind of yes and no. Understanding the law is helpful, but having not practiced law, I really can't do too much myself. It's like going to law school is not the same thing as being a lawyer. That's for sure.
Well, I am very curious about the statement in your bio here that you are building disruptive technology startups. Can you define what a disruptive technology startup would be?
So the first time I learned this term was while I was in business school, and I sat up and took notice of it. I think the person who popularized this term, and you see it a lot in the media, sort of disruptive technology, is a guy by the name of Clay Christensen. He was one of my professors at Harvard. And what he means by the term is really, at an intellectual level, really fascinating to me. It means when he says a disruptive technology, a lot of people think, oh, disruptive just means you like to break things, or you like to cause a ruckus. And actually, you might point to certain technologies and think that they do, but Professor Christensen meant something very specific by this. He meant it's a technology that at first appears not to be very threatening by incumbents. Like it's underpowered. It doesn't do very much. It's kind of like when Amazon first showed up. Everybody thought Barnes & Noble was going to kill Amazon, right? Amazon was a disruptive technology because everybody looked at it and said it wasn't a threat. But the truth about most successful disruptive technologies is they do one job really, really well. And that job grows and expands and becomes more important over time and becomes more important than people expect over time. And that's what I found very exciting about the internet. It's an open platform where people can innovate quickly, and technologies that appear to be little toys or might be insignificant can quickly grow up to be very significant. You just look at the impact of internet technologies in almost every industry in the last 20 years, and you certainly see that. So that's what I mean. I enjoy building those types of companies where, take ground floor, for example. When we first started, there was a lot of doubt about the fact that the internet could be used to finance much of anything. And now people don't really doubt that. Now people are asking, well, how much more could it finance? And what would that look like? So I think that process is really, as an entrepreneur, pretty exciting.
Now, if you could, before we jump into the sort of the financing side too,
Sure.
just maybe you could just touch on the Republic Wireless. I mean, that I can understand. That makes sense as a disruptive technology, because you've got these major, monopolies here that control the cellular world. Tell me a little bit about that.
We playfully called the big four wireless companies Big Cell. Kind of like big oil.
Yeah, right.
Because a lot of people feel that way. In our research, we found that people didn't like being locked into contracts that were very expensive. We found people didn't like what they, sort of the terms of the deal, but they really valued wireless service, right? Wireless service did a job for them that was really important. And we all became very reliant on it. And the more reliant we are on a technology like that, the more frustrated we become. Well, the fact is, and I think this is true in finance, as true in finance as it is in wireless, we as consumers today have never had more power and information to change the landscape to our liking, to suit us. And so with Republic Wireless, for example, we said, yeah, you need access to regulated spectrum and cell towers while you're driving around town. But 80% of the time, we're all around Wi-Fi networks. And Wi-Fi networks are good enough to do the job that you hired the cell phone to do. And wouldn't it be amazing if you paid 1/10 the cost, weren't locked into these contracts, and could enjoy service that operated on Wi-Fi most of the time, but then just the technology seamlessly went off, rolled over to fell back to the cellular network whenever needed. And we just built a very popular, very powerful concept based on that back in 2011 when we launched it. It was the most successful thing I had done in my entrepreneurial career to that point. And, it's still successful today. Actually, the company is still fighting, still doing it, still growing.
Yeah, I mean, that's a pretty impressive first out of the chute business to to take a hold of and drive. I mean, that's huge, tremendous. But you moved into the finance area, and I don't know if you were, an investor or a real estate, maybe somebody that was involved in real estate investing. But why this niche that you zeroed in on with Ground Floor?
Well, I was looking for my next industry, right? I had spent 10 years in the wireless industry, and I felt like what I saw in the wireless industry was probably true in other industries. And so I started interviewing people about, if you were around me back in 2010, I probably would have interviewed you about, what services and products do you use that you really need, you find value from, but you're frustrated by the way that they're provided. And I'd made a long list of those. And, finance kept coming up. And I think people felt that way because of what happened in 2008 with the liquidity crisis and everything that happened in 2008 to 2011 or 12. That impacted a lot of people negatively. I think I discovered that people feel like the game is rigged against them when it comes to saving and investing, that public markets are no longer trusted, that intermediaries who you utilize in order to try to overcome that are expensive or can't be trusted or are frustrating or not accountable. And we discovered a lot of those problems. And I became interested as an entrepreneur how the internet could be used to overcome some of those problems and do the job better of helping us all save more and invest better with less risk. Because that's what's frustrating. Everybody feels like they're forced to take on so much risk for so little reward. And it turns out that isn't true if you're one of the 4 or 5% wealthiest Americans who's already made it. And if you're a client of Goldman Sachs, the financial world is your oyster. But the rest of us are left with something that's a lot less compelling in saving and investing. The reason I got interested in that is turns out I bought my first mutual fund when I was age 15, right? So I've been an investor for a long. I've been an investor for a long time, and I've always thought that's an interesting field. So I had an affinity for it too.
Well, yeah, and I think you really hit on it when you talked about that higher, that 1% that the people that are wealthy are just getting wealthier because they have access to the best investments, and real estate is one of those that has great returns, and it's also it's a tangible asset that as opposed to just a paper asset like you might find. On the stock market and so forth, you really have something there. But for people to do it, buying into a REIT or buying into some of the options out there weren't that great. And a lot of people who were sold a REIT by their financial advisor, maybe some of your listeners fall into this category, say in the 2000s or the 1990s, a non-traded REIT, found that their money was locked up when they most needed it. Very frustrating when a REIT stops redemptions. And this is what people have the feeling
that they shouldn't be subjected to these kind of limitations. It's like being locked into your cell phone contract or being locked into a REIT. The fact is, the world is set up in such a way that you should be free from it. And somebody just had to come along and unlock that. And we did that with Ground Floor. I mean, we didn't know it was going to be real estate at the beginning. We actually made a list of about 20 different categories, some of which were real estate, where we felt like an investment product could and should exist. And then through talking to people, we realized, a lot of the benefits that you were just talking about with real estate, people really do understand it. It also turns out that at any given time, between 60 and 65% of Americans are already investors in the asset class of single-family housing real estate because they own a house. So
Right.
it's the largest asset most of us already have, so we better understand it and be familiar with it, to some extent.
Right. Well, you were a bit of a pioneer coming into this field. Now, crowdfunding is a common term, and there are a lot of folks that are sort of in that space. But you differentiated yourself. Maybe you could kind of address that. What made you different as you entered into this space?
Well, the first thing is what we said back in the day when we noticed all these people were kind of coming into real estate crowdfunding is we actually put the crowd back into crowdfunding. Because what was being marketed out there was the opportunity for accredited investors. And if you're an accredited investor, this is great for you. These real estate crowdfunding sites were cropping up that would allow accredited investors to participate in syndications, right? And they would call that crowdfunding. My objection was, what about everybody else who's not an accredited investor? That's 96% of U.S. households do not meet the SEC's definition for an accredited investor. So what about everybody else? Everybody else is just left with the same old REITs and, funds. And so we're the only option, we're the only issuer that has been qualified by the Securities and Exchange Commission to offer a direct participation security in real estate. So on Ground Floor, you can, with as little as $10, most people, of course, invest a lot more, come in and invest $10 per property or per loan and build your own portfolio. I mean, if I told you that you could buy into the stock market, but you could only buy an index fund or a mutual fund or an ETF, you couldn't just go buy individual stocks. You'd say, I'm crazy. I want to buy my Facebook, my Google, my Netflix, my Amazon. But the market in private lending or in private securities markets says we can't do that. So we created a product where that is possible. And nobody else has done that. Nobody else offers that kind of control and self-determination to the other 96% of us.
It's amazing. It really is amazing what you've done. What kind of investments are there out there, and what kind of due diligence can the people that go onto your platform do to to find out more about what they're investing in?
So the other differentiator that I'll add that has to it directly applies to the question you just asked me, is that because we're qualified by the SEC, you can learn everything about how we diligence our investments, how we disclose what we learn. It's all in a very consistent, rigorously applied formula that we have to, by the regulations, apply consistently all the time across hundreds and hundreds of loans. So that turns out to be good for the accredited investors too, because these private securities markets are typically, there are no disclosures, right? It's nothing close to what you get with a public company, whereas ours is. We have audited financials and an offering circular that you can read. On our platform, what you'll find, because we've so tightly regimented it, is a range of investments that are graded A through G. A grade investments are lower risk because there's a borrower with more experience. There's less leverage on the property. And grade G might be a riskier, more speculative investment that also has a higher yield. These are typically house flips or new construction projects that are, loans that we've made to a real estate investor who's going to go acquire a property, fix it up and flip it, or rent it out and refinance it, or, build from ground up. And so there's a variety of projects like that. They're almost all single family housing projects. And the terms, this is what people really love. The terms are, typically a year or less, typically 6, 9, or 12 month terms. And the yields range between 8 and 12%, depending on the risk grade. So really high yield, really short term, in a category that most people understand. And even if you just watch house flipping shows, you kind of understand what the borrower is doing, and a price point at $10 where people can kind of diversify very broadly, and build huge portfolios of loans without much money.
So you, as an investor, can look through, various types of investments. Okay, I see, somebody's building a house over here. They're flipping it. Another person may be doing, a bigger project or multiple homes. I'm not sure what the offerings might be, but they basically select these homes based on their risk and the information that's provided, and they could just now there'll be certain terms, right, with each investment. For example, a flip is going to be a fixed period of time before that's going to be paid back.
They're all always loans with a fixed term. So as I look on our site today, there are, call it a half dozen loans funding right now. One of them is looks like a row house in Chicago. Another one is in Stone Mountain, Georgia. That looks like a ranch. Both of those are 12-month loans. One of them is a grade C, one of them is a grade B. And these are, projects where they're going to acquire the property and then they're going to renovate it and then they're going to sell it. And that usually takes about 9 months, typically.
Gotcha.
Which is when you get your money back. When they finish that project, they have to repay the loan. They repay the loan, and then we repay our investors.
And what if the investor wants to take out earlier than the 9-month term?
Well, that's why we did this $10 price point and why we really preach, the virtues of diversification. So if you put all your eggs into one basket, let's say even if you make the investment as an investor into a project, right, and you put in $20 or $30 or $50,000 into an investment, into a property, you can't take it out until you sell it or refinance it or something, right? With us, we hope you would take that money and spread it out into a lot of loans so that even if one loan is taking longer to repay, because sometimes projects run long, surely there's another one that's probably repaying early because it got done sooner. And so on balance, it's pretty easy to take your money out as long as you've invested in enough loans. And that's why our minimum, investment is $10. So that, even if you only had $1,000 to invest, you can have 100 loans. And at any given time, something is paying off. So you can take your money out. But you can't take your money out of any given loan until the loan repays because you've made a loan.
Gotcha. And do you have fixed criteria for the types of folks that can, on the other side of the coin here, the people that need the funds for a project, for example? Do you have certain criteria that they must meet in order to qualify? They're basically getting a hard money loan, right, for the most part?
They are. Mm-hmm.
And so what kind of criteria do you have on that side?
Well, we look first and foremost at the borrower. We are asking ourselves the question, does this borrower, this person who's taking on this project and wants to take out this loan, do they have a plan for this property that makes sense? So we're looking at them and their experience. We're looking at the intensity of the project. We're looking at the prospect for the project's success. And equally, we're looking at the collateral itself and saying, well, hey, is this property, did he overpay or did he get a good deal on it? Are they going to be able to achieve an exit valuation that makes a fair return? Because we're not interested in financing projects that we don't think will make a fair return. And so we turn down a lot of loan applications because we don't conclude that the business case makes sense. And some people have thanked us for that. Some people have cursed us for it and said, you won't give me the money, you're just like the bank. And other people have said, thank you very much. I didn't realize that, this market or this submarket might be challenged, because we look very critically at what the market's going to be 6 or 12 months out when you're going to try to sell it. But the most important thing is, do you have the experience and the track record to convince us that, you can succeed at this project? And that's the most important thing. So we have a number of ways of testing that.
And so your underwriters that are qualifying these people, I mean, they're looking at their, let's say, their ARV numbers and verifying that the market will bear what they're projecting and so forth.
We do all the things you would expect. We have institutional grade lending criteria here. I mean, we do a background check, and so we know who the person is, and we want to make sure that that they have a good credit history, so that they have a pattern of repaying their lenders. And we work through all aspects of the deal: the person, the plan, and the actual collateral. Yeah.
Gotcha. And right now, the economy is definitely changing. I mean, those of us that are investors are, facing what was a buyer's market is very much a seller's market. But even at that, we see declining home prices and property prices right now. Does that make it a little more challenging for you as we maybe move closer to a market correction or a recession ahead?
I mean, every phase of every market presents good opportunities, for the right investor who's thinking about it the right way. So I think for us, that's the question. We look at each locality where we lend. We make sure we understand the dynamics that are working there. And this can get down to, the neighborhood level or even more narrow than that. So our opinion is that there are many, many places where some of the dynamics you just described aren't present, at least not yet. And we're active in those places. And then even where house prices are declining, where some things are under pressure, we have customers who, real estate investors who want to borrow from us who are opportunistic, and use that as a good buying opportunity. And so we're ready to supply them with capital. The key is just to make sure that you're prepared for what's coming. And we think we are. I mean, we think we have a broad enough, customer base, enough capital, enough market intelligence at this point to navigate pretty much any environment. I mean, the primary factors that drive demand for the products that our borrowers are, developing and selling are alive and well. The in-town urban infill sort of project, if you were developing new construction, in a suburb 50 miles outside of town, those pressures on pricing and sort of market liquidity are a lot more present than they are in most of the markets where we are. So we pick our spots.
Do you do new construction projects?
We do, typically in areas where we're convinced that there's not going to be a glut of supply. So and we'll only do it with independent builders who are working at a low volume or a low scale and don't get overextended. So we're pretty careful and choosy about that. We launched a pilot program last year that's gone pretty well, and we've done some new construction in and around Atlanta, which is our hometown, also around the Triangle region of North Carolina, and a couple of other markets where we're just experimenting with it and making sure we understand, that product and, how it'll sell well. And the other important thing that we do in our business is managing after the loan. So we service and asset manage everything we do as well. And so as a business, before we scale something up and start selling these products to investors, we want to make sure that we really understand, how to be successful at it. So we've been pretty slow to get started in that area, but we do some. Yeah.
If I got you right before, you mentioned you don't do multifamily. It's all single family. Is that correct?
We've done a little bit of multifamily, not at a large scale. Like a big multifamily deal for us would be like a 10-door deal. We've done a couple of those. I think we did one 20-door deal at one point. So in selected markets, in certain positions with certain borrowers, we'll do them, but it's not the main part of our business, no.
Why aren't you pursuing, the 100 plus, 200, 300 unit type multifamily opportunities?
Well, we're here to, our main purpose is to build a product for the individual investor. The individual investor benefits from diversification. In order to benefit from diversification, we've got to keep a low minimum and have a lot of different product to choose from. And so we've never been the kind of company that is trying to put as much capital to work as possible, which you would probably do by doing a lot of larger projects. There are a lot of people who are operating in that space. There's a lot of capital going into that area. We have strategically chosen to stay at the lower end of the small balance lending spectrum, and that just gets to because if we have in December our investors put $8 million in capital in aggregate into different investments. There's something like 2,500 investors who put about $8 million to work. We would rather that $8 million be spread into 80 projects, by those investors instead of into 8. And I think that's why we have chosen to stay at that part of the market.
Gotcha. What would you say would be a common mistake that passive investors make in this space that you're in that our listeners could learn from and hopefully avoid?
Well, the biggest mistake that I see people, and I understand why they do it, is they over allocate into they put all their eggs into one basket. They over allocate into one project or to one opportunity. There are a lot of ways to get started in real estate investing today. And I don't think in today's market you have to take that kind of risk. Now, a lot of people do it because they think, well, I'll be better informed about that. I'll put all my wood behind one arrow. But you have to ask yourself, what is the range of returns that you're going to get, with that one investment? And if you're okay bearing that risk, and the risk could be losing your money on the investment all the way to making a really excellent return on it, then that's okay. But I think most people are more comfortable with a narrow range of outcomes. Sort of if you look at, for example, we did a graph of the average return realized by over 3,700 portfolios. This is on our blog at groundfloor.com. If you look at that graph, if you invested in at least 20 projects, you're pretty much, the returns empirically came out to somewhere between 8 and 12% on average. All of the portfolios were in there.
That's great.
Yeah, but all you had to do is invest at least 20 projects, and you get that return. Now, if you only invested in 1 or 2 projects, and this is exactly what I'm talking about, you might have made 18% or 20% on your money, but you also might have lost money. I think there were a couple of portfolios out there that lost, 20% or more of their money. And so I think the lesson, if you're getting started, is there are options for you to go out and diversify. And a lot of people think if they're going to diversify, they have to give up choice. But that's the problem we're trying to solve for you, which is to give you the choice, but also help you to diversify. And I think, not putting your eggs all in one basket is an important lesson to learn. A lot of people have to learn it the hard way before they start doing it.
Now, do your investors, you mentioned they don't have to be accredited investors, but do they have to be sophisticated investors, or
no.
There's absolutely no requirement? Is there an age requirement?
I mean, I believe under the terms of our offering, I think, I'd have to check. I think you have to be 18 in order to invest on your own. You got to be legally responsible. Right. But if you're legally responsible and you have money to invest, there are a lot of people who have their first job, and sticking their money in the bank doesn't seem to make sense to them, and the stock market seems too risky, and they want to participate in real estate investments. If you have $100, you can have a portfolio of 10 loans on Ground Floor. The average investment is much more than that, but we really have everything from people who are just getting started like that, all the way to people who are investing tens of thousands per loan, and have portfolios in the hundreds of thousands of dollars, and everything in between.
Gotcha. So let's say, for example, I'm an investor. I've got $20,000. I'm going to take $1,000 and put it into 20 different projects here. Yeah. So what happens to the funds? Okay, they're going to be different terms, I'm sure. Some will come due in a few months. Some may come in a couple of years. What sort of happens to the funds at the completion of a project? Does it go into sort of a holding account?
It goes into an FDIC. It's like a brokerage account. It goes into an FDIC, account, FDIC insured account that we hold for you, for your benefit. And you can either withdraw that from that account, or you can invest it into another loan. That's what happens about 80 to 85% of the time. people are just reinvesting into the next loan because they want to keep making the return.
Sure. And can people be in a self-directed IRA or a maybe solo 401k or something like that and still invest?
Yeah, if people have so we have some customers who have check writing authority on their IRA, and that simply means that your IRA provider let you invest your money into an LLC. And this is a pretty cool trick that a lot of investors have figured out. Then you can set up an account on that basis. A lot of people have done that. And then we also have an IRA provider who handles all of the compliance and so forth. And we can help you set one of those up too for investing just in the ground floor loans. So we have some people who've gone through that process. Yeah, it's growing in popularity for sure.
Gotcha. Well, our audience is primarily people that are 50 years of age and older. These are people that are approaching retirement or already in retirement. They have a range of concerns. Some people have their nest egg together, and they're just looking at getting good returns on what they have already accumulated. There's others that are looking at generating, cash flow too in their retirement. Maybe they want to supplement maybe the amount that they have and isn't what they had hoped it would be so that they could have the retirement that they want. So they're looking at real estate investing, for example, as a means to be able to fill that gap. What kind of advice would you give to those people that are looking to get good returns on their funds or to generate cash flow?
I don't know if the metaphor appeals to everybody, but back when I was getting into biking, I was really into Tour de France. I was really taken with that on the on TV back in the day. I had a financial advisor who gave me a metaphor that's always stuck with me. It said, it's like the riders in the Tour de France. They have one guy on the front who's kind of pulling and doing the work for a little while, and then he rotates back to the back of the peloton, and then the next guy comes up. And they said, you want your investments to be doing that for you as well. You want to have lots of investments that have different risk and return profiles, that have different cash flow profiles, and that are distributed across the risk spectrum, right? Like on ground floor, you want to have loans that are grade A, and you want to have some loans, if you can stomach the risk, that are graded D or E or lower. And I think that's good advice because you want to have lots of riders, if you will, or lots of investments working for you. And that, to my way of thinking, and in my experience investing since I was age 15, has when I have stuck to that, I've been happier because even if I didn't make as much money with that strategy in the short term, I've had a lot of peace of mind about it, and I have felt more stable and better served over time. So I like that. I like that metaphor. I guess that's what I would offer people.
I like that. Well, your company is just it just seems like it's just poised to do some amazing things. What, as CEO of this company and co-founder, what do you see in your both your short-term and long-term future for Ground Floor?
We just celebrate our 6-year anniversary of our founding, which is always a moment where you say, well, what's the next 6 years going to be like? And it's very difficult to foresee in my line of work what even the next year will hold. It's always surprising. But I'll say we did one thing last year that I'm particularly excited about, which is, we as a company are on a mission to open up these private capital markets so that everybody can participate, not just the accredited investor set or just the institutions. We think everybody should have the benefit of that, and without giving up control. I think that's what people want. So true to that mission, we opened up ownership of our company itself to our customers. And we didn't know whether people would be, whether our customers would be interested in owning stock, in the company itself. Before we had raised venture capital, from VC investors and from early stage angel investors, but we didn't know what that would be like. We were amazed. About 2,300 people invested in the company to the tune of $4.2 million last year, and now own 14% of the company. So that's how we financed our growth last year. And we're doing the same thing again this year. We decided to open it up again. It was so successful. So I think that is going to reshape our company in ways that are exciting and difficult to predict. That is doing something like that is you have to take a leap of faith in order to do it. It's bleeding edge stuff to say that you would sort of open up ownership of a startup company to that many people so early in your life. I mean, we have as many shareholders as a lot of public companies, at this stage. And so I think that's, as I look at our future, I think that's the future. It's opening up the ownership of our company, providing many more different types of products. I mean, for example, instead of just house flipping debt, we're now looking at other types of products that we can offer, whether it's participating in some of the equity upside of these real estate investments, and if so, through what vehicle. So we're really now, at 6 years in, we're now at a stage where we can open up a much broader variety for our investors, and I think that's going to take us in all kinds of new and exciting and difficult to predict directions. That's a cool moment for us.
That's great. What about in terms of, let's say you have somebody, well, this is kind of like a hard money loan. Why don't I just do my own hard money lending? What sort of maybe protections or other things do you have in place that would prevent somebody who wants to maybe be their own hard money lender instead of going through a third party here from doing that, as opposed to investing in or through ground floor?
Well, having talked to some people who've done that, they've taken their IRA, say, for example, and experimented with lending it out. I think you have a few challenges that we would hope to solve in a way that would win your investment business away from doing that. One, and I think the most important, is the opportunity to diversify that investment. So instead of lending out $50,000 to one borrower on one project, being able to spread that out into more. A lot of people might say, some people might say, I really want control over the money, and I feel better about putting it just in one project that I really understand. The problem there becomes which project, and how do you know? It's something that I called in our early days the Groucho Marx problem. It's like, I wouldn't want to make a loan to anybody that would take one from me. How do you know that you're not the victim of adverse selection? And so we solve that problem by building a huge pipeline of potential loans and having very rigorously vetted criteria that have performed over the course of a 5-year track record that you can see on file with the SEC. We're not making up our track record. We file it regularly with the regulators so that you can see how it performs. And I think those are real advantages, and I can understand why people get into hard money lending. I don't understand why they stay in hard money lending.
That's great. That's a great answer. It's very intriguing, I mean, it's what a great niche you found. Do you ever look at, or the possibility? Let's say somebody is investing a lot of their funds in ground floor. They like the diversification, but let's say all of a sudden they need a big chunk of cash. They don't want to have to lose the project they're in. Have you ever thought of people that could maybe borrow against their investments that are there? Maybe like you can do with an IRA or something like that, where you could take out a loan to get access to your funds when you need it, if there's that situation presents itself.
So when I said a little earlier that I'm excited about the next 6 years because of the broader range of things we'll be able to do for investors, what you're describing falls into that category. We know that, life happens and people need access to their funds, and people change their mind or have something happen where they've got a different risk profile. And while we're, too young to accommodate that today, we don't have the right product to do that. Someday we will, because we're just very serious about meeting the needs of individual investors and giving them the same benefits that, if you were a client of Goldman Sachs, you'd be able to do that. Goldman will help you with that. But to be a client of Goldman Sachs, you got to have 10 million of investable assets. Not most of us don't have that.
Right.
So, yeah, we're very serious about bringing all of those types of benefits and features, to market over time.
Great. I love it. Well, Brian, this has been great. You have had some great information here. I appreciate your sharing it with us. We're kind of moving to the end of our time period here, and we have a little section we call the Wrap It Up section. Basically, I ask you a whole series of quick questions that hopefully will be valuable information you can share with our listeners regarding resources that you may use or references that might be helpful for people. So if you are ready, are you ready?
I'm ready.
Wrap it up. Here we go.
Okay.
All right.
Let's go.
Favorite real estate book?
Well, this one isn't about real estate per se, but I know it applies. Howard Marks' Mastering the Market Cycle is a really insightful piece of work for investors in anything, but also in real estate. And I think it's especially important for where we are right now. He was the chairman of Oaktree, pretty famous guy. So Mastering the Market Cycle.
Great. And I think that's very real estate relevant. If you don't know your market, man, you shouldn't be investing. So that's great stuff. Favorite business book, more general business book?
I loved Phil Knight's book, Shoe Dog. It's a great company narrative. As an entrepreneur, I can really identify with the ups and downs of what it took to start Nike. And it's a really, really entertaining read. Love that book.
Great. Another good recommendation. How about most valuable website for success other than your own?
I'm going to take a page from the book of several of our customers who've shared this with us. If you haven't checked out Bigger Pockets yet, that website and blog has a lot of forums and articles and programs for people who are interested in real estate investing, and I think it's a good one. There's a lot of great content out there on Bigger Pockets.
I second that, definitely. How about a favorite app that you use?
Oh, that's easy. Audible. I love the podcasts and the books. What is not to like? I listen to, if the author is reading slowly enough, I try to listen to it at 1.25x. So I get through the book just a little bit faster. And it's amazing to me how much time there is in a day when you can kind of listen to an audiobook, not only driving to work, but then in the elevator on my way up to my office, I'm listening to the book still. It's as I'm fixing my coffee, I'm still listening to the book. So I like that. It's a great way to get through a lot of material.
Totally with you on that one. I absolutely love that. This is like living in LA. I just love the fact, especially sort of my retirement years here that I didn't have to drive anywhere. But now I look for opportunities.
I know
to meet for coffee, but they're like 2 hours away. I'm going, great, I'll be there.
Yeah, I'm listening all the time. It's great.
Yeah, I do too. I love that. It's awesome. How about your favorite quote?
Well, I went to UVA for college, and so it has to be a Thomas Jefferson quote, and he has a lot of good ones. But for me, and what I'm all about, I like his quote that I hold it that a little rebellion now and then is a good thing. That's my favorite Jefferson quote.
I like that for a person who's disruptive like you, right?
Just don't tell my teenage son that.
Yeah, right. I love it. Great. And here is our apocalyptic question here. If something happened and you lost everything you had and all you had left was just $1,000 in cash, what would you do with that $1,000 to relaunch your business?
I would invest it in ground floor notes. I would buy ground floor LROs.
That's definitely
I would, shameless plug. I would
really definitely a shameless plug.
I would invest $10 in 100 loans on ground floor. That's what I would do.
Oh, I love it. Wow. Well, this is really great, man. It's been such a pleasure to have you on, and I'm sure there's people listening that would like to find out more. Maybe find out more about your company, more about you, or be able to have maybe there's some questions. I'm sure there are plenty that I didn't ask that people would like to ask. What's sort of the best way for folks to find out about you and your company?
Well, I am available on email at Brian, BRIAN, at groundfloor.us.
Wow, that's pretty nice of you to offer that. Great.
Absolutely. Email me. I'm happy to. I try to reply as quickly as I can. I'm on it all the time. Just life of a startup CEO. So I'm happy to correspond with people there. And also, our website is www.groundfloor.com. So easy to find us there.
Fantastic. Well, we have a tradition here, which I know you know about, and I hope you've been practicing for. But we have our guests always close us out with their best old hound dog, spelled D-A-W-G, howl. Okay, so if you are ready, Brian, are you ready to close us out with your best old hound dog howl?
I'm ready.
All right, it's all yours, man.
Oh,
That was excellent. Hey, not bad at all.
honestly say I've never been asked that on a podcast.
I love it. Well, thanks so much, Brian, for being on. And I know our listeners are going to get a lot out of this. So thank you very much.
You bet. Thanks for having me.
And I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. Please note, old dog listeners, everything presented here today can be accessed in our very detailed show notes on the Old Dogs REI website at olddogsreinetwork.com/blog. And you are going to look for the episode with Brian Dowley. So that is the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward. And may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.